Hey guys, happy Wednesday. I guess we're in the week already. Jeff Kamke here with Wealth Energetics, going live today during our normal agent panel time. Chris is at a conference this week out in Colorado with Better Wealth with Caleb Williams. So Matt and I are going to still hop on and share some good quality content with you. We're going to review a video today that I saw a while back that I think raises my blood pressure a little bit. So we'll share our wonderful thoughts on
Is
all
it
that.
is it the actual video that raises your blood pressure, or is it who's doing the video that raises your blood pressure?
I don't know. Maybe
I was
both.
I was going to ask you earlier if you actually want to break this down, because we might end up agreeing with him on
There are a
things,
few
on
things.
quite a few things, which we normally don't do.
Yep, there are a few things that we will agree. Yep, for
Yeah.
sure. So I think it'll be a really good, discussion here because there's going to be some things that we definitely disagree with on many levels, and for some very specific reasons. There's going to be some things that we actually do agree with him on.
Yeah.
And I, got some new perspectives that I want to share. A couple thoughts around that I watched something yesterday from Caleb Williams actually that's making me think a little different about some of this stuff. So going to be exciting. So glad to be with you again, Matt. And I don't know if you want to introduce yourself at all, but
Yep.
we can jump in.
Matty Ice from Millennial Wealth Creator. And today, we're talking about one of my favorite things to talk about. This video is discussing IUL and all of things that are wrong with it, which when I was going through it originally, I agree with it. There's also, a number of things that this gentleman says that is inaccurate, and it's really his opinion. That's fine. I'm totally cool with people sharing their opinion. My thing, though, if you guys have been following me any amount of time, I say this on my channel on a regular basis. Almost every video is like, I don't care. Like, it doesn't make any difference to me if you go with IUL, whole life, neither. It doesn't matter. And I don't even have a problem with people selling whatever types of products they want. It's just get the full story, right?
Mm-hmm.
Understand how these things actually work, both IUL and whole life, the infant banking concept, etc. Understand how these things actually work so you can make the best decision for yourself. And a lot of the times people are only telling half of the story. And I think that is a really big problem. It's why I think doing breakdown videos like this is really, really important, because we're going to listen to George. How do you pronounce his last name, Jeff?
I think it's Kamel.
Yeah. From the Dave Ramsey team, talking about IUL. And when I was listening to it, I agree with a lot of things that he says about the fundamental flaws of IUL. But then he also starts bashing whole life and cash value life insurance in general. And, it's fine to share that opinion, but you got to make sure you're doing your research to understand how these things actually work, so that you can make the best, you can make an actual educated, informed decision, because IUL might be right for you. It's usually not, but maybe it is. Whole life could absolutely be right for you, but how do you know that if you don't know how it actually works and you're just listening to one side of the story? So that's what we're going to be doing today, is breaking down this video, giving our thoughts on IUL, whole life, cash value, life insurance, etc. And it should be a lot of fun. I appreciate you setting this up, Jeff. It's going to be a good time.
Yeah, absolutely. I think before we could get the video rolling, I think one other thing I want to add to what you were just saying is, I was watching a Caleb Williams video yesterday where he was interviewing another guy that's had a podcast around life insurance for like over 10 years, and just talking about how, one camp that's pro, say, whole life will look at another camp, maybe the IUL camp, and bash for certain, talking points, and vice versa. And how do you differentiate, even as an agent, sometimes it can be challenging, properly designed versus an improperly designed, policy, whether it's an improper IUL or improper whole life. Like, there's good and bad. And so there's this spectrum that you have to look at of like poorly designed whole life all the way to poorly designed IUL versus properly structured whole life versus properly structured IUL. Like, there are differences. It changes the characteristics of them, and it changes the talking points, because some of the talking points that one camp will use is the camp where it's not set up very good. And I know with whole life, there's a lot of whole life out there that's very poorly written, poorly structured, that's not very good. That when we would look at that, we would say, yes, that is horrible. It's not very good. We would agree with Dave Ramsey on that point. So I think that's some of what will come into the discussion today, of seeing where those boundaries are, where the spectrum is, and being able to bring that more to the middle for education. So you're educated, so you know what you're getting into and where it fits into a bigger financial picture, a bigger financial structure, and strategies within that, so that you're doing what you need to And I think that'll come out in our reaction video. So
I think that's a fantastic point. Just a couple things on that really quick. I can give you real life examples of both sides of that equation. I'm working with a client right now. We're setting up a policy on his wife, and he originally had a whole life policy set up with a major mutual company. And he thought it was set up for something else, and it wasn't. And once we started to break it down, like the way I started work with him, he saw that I was implementing infinite banking. I was setting up these policies, and he saw my policy design. He's like, that's what I wanted. And then we were breaking down his current whole life policy. It was the exact opposite. Like, he doesn't break even until year 14. He has very little cash value, and he wants to use his policy to build wealth. So naturally, he was really, really pissed off, and he almost canceled it. And I calmed him down a little bit. I was like, look, I know it's not what you wanted. You can, the premium's not going to bankrupt you or anything. You make really good money. It's not going to hurt you in the long run. It will eventually perform, I would say, because that's the thing about a poorly designed whole life policy and how it's very different from a poorly designed IUL, is that with time, the whole life policy will be bailed out. Now, that doesn't make it okay to not structure the policy correctly, but you're not going to get hurt by the policy, a poorly designed whole life policy, the same way you would an IUL. So in that scenario, I would absolutely agree with the Dave Ramseys and Susie Ormans of the world, where whole life is a terrible place to put your money. If you're trying to build wealth with it, et cetera, those 100% base whole life policies that are not designed correctly, sure, those can be pretty bad, and especially if it's not what the client wanted. On the flip side, I've also seen, I don't see it very often, but I had a conversation with an IUL. I'm not even going to call him an IUL agent. He's very product agnostic. He does whole life, IUL, everything. But he showed me what I believe was a properly illustrated IUL with there's 0 years in there. He's not taking policy loans for the income. He's doing a withdrawal up to basis and then policy loans. Like, I looked at that illustration. I was like, okay, if this is how it was presented to people on a regular basis, which I've never seen it done like that, but if it was, I don't think I would have as big of an issue with it. It's the way that it's marketed and presented as this financial unicorn product that's going to solve all your problems. And, George mentions that in this video that we're going to break down. And in that particular case, I was still not sold on IUL. It still did not make sense to me. But if it was presented that way, I would say, okay, that's something that people could consider. If you look at that and you're okay with it, that's fine. But so it goes both ways. Unfortunately, a lot of times IULs are not set up properly, and that's when they can really blow up in your face later. But yeah, it comes down to understanding how these things work so that you don't fall victim to that. So you don't get what to look for. You know how the policy should be designed. You know the right questions to ask. Like, you don't need to be an expert in this stuff. That's what the agents, that's their job. All right. But you need to understand a little bit about policy design so that you make sure you're getting what you want, what you expect. That's the main thing. So, yeah, I've seen that many times. And, I've seen it too, where you were mentioning, people who are IUL advocates will talk about, or not even IUL advocates at all, but just don't like cash value life insurance in general. If it's not set up properly, they'll stick with that part of it right there, and then they don't talk about, well, what does it look like if it is properly structured, right? And then vice versa. So that's why I think doing these videos is really important to kind of cut through that noise. So I'm excited.
So cool. I'll share this screen here.
All right, we're gonna. I sped it up a little bit. We're gonna play it through first because it's only 5 minutes long, and then we're gonna go back through it and pick it apart a little bit. So here we go.
Hey, George Kamel here, Ramsey personality and financial expert. I'm also a millennial and social media aficionado, and I've been seeing lots of terrible financial advice all over social media. And the one that keeps popping up is this thing called universal life insurance. Now, here's how it's marketed. You're supposed to use your life insurance while you're still alive, right? And everyone's like, brilliant, an investing policy inside my life insurance. I'm going to become a millionaire. And they're always touting this crap as secret wealth hacks of the rich. No, hard no. Who actually benefits from index universal life insurance? Well, to answer that, let's break this down into bite-sized pieces and see what it's really made of. Here's what we're going to cover: what index universal life insurance is, how it works, and whether it's a smart money move or a money-eating monster. Let's start by defining Index Universal Life Insurance. Gosh, that is a mouthful. I hate it based on that name alone. Let's give this guy a nickname. We'll call him IUL for short. Okay, sadly, that's still just as annoying. Anyways, IUL gets pitched as this really sophisticated, nuanced, it's so complicated you don't understand, just trust me, bro, I'm your insurance guy, I'm gonna make you lots of money, kind of thing. Really gross. But it really just puts a new spin on an old and terrible idea. And that idea is whole life or cash value life insurance. It's where you have an investment account and a life insurance policy rolled into one product. And it's something I never recommend because it tries to do two things at once and ends up sucking at both and costs way more than term life insurance. But more on that later. With IUL, you're specifically investing into index funds, hence the name Index Universal. Even if you're an investing rookie, you've probably heard of the stock market and some of the most popular indexes, like the Dow Jones and NASDAQ, with those little green or red arrows on your TV screen. Well, with IUL, a chunk of your monthly premium gets invested into index funds. Now, don't get me wrong, I'm a big fan of investing in the stock market when it's done right, but this isn't one of those times. And don't even get me started on why investing with your life insurance agent instead of, an actual investment advisor is a bad idea. And here's the real catch with IUL. Your return on investment will always be slightly below the actual performance of the index. Why? Well, because the commissions and fees your agent makes by selling this crap are insane. And guess where those fees get taken out of? That's right, your investment account. Sound too bad to be true? It isn't. And as you get older, the cost to insure you can start wiping out your entire premium every month. And that means you'll have nothing going toward the investment side of your policy. The insurance company will even start dipping into your investment account to cover the cost of your premium. And now you've got a real money-eating monster on your hands. With IUL, the two good intentions of life insurance and investing can end up canceling each other out. Imagine paying a ton of your hard-earned money to an insurance company every year for the rest of your life. And if you actually want to use any of the cash value in your investment account, you have to borrow your own money and pay it back with interest. Your own money. But hey, if your investment ends up doing well and doesn't eat its own weight in money, at least your family can live on the extra investment money after you're gone, right? Think again, my friend. Here's the real stinger. Your family only gets the original amount the policy is worth. In other words, if you bought a $250,000 policy but ended up with an additional $180,000 in your investment account, your family still only gets $250,000 if you die. And with that, I ask, what's the real point of combining insurance with investing? If you said helping insurance companies make more money, give yourself a whole star and a high five. So let's compare IUL with term life insurance, which is designed to keep coverage simple. Term life companies know the cost of insurance goes up over time. So based on your age, the company looks ahead 15 or 20 years and offers you the average rate for the entire term. That price gets locked in throughout the life of the policy. No fluctuating premiums and no worries about a bad stock performance wiping out your policy. Sound like a smarter way to protect your family's finances? You'd be what's known as right. And with all that money you're saving on premiums, you can invest the difference and build wealth in returns. If anyone depends on your income, you need life insurance. It's to replace your income.
All right. So that was the bulk of what we're going to break down with all the IUL stuff. Man, had to bite my tongue a couple of times, jump in and be like, dude, what are you talking about? But yeah, thoughts, just overall thoughts on the video, Jeff, and then we'll pick it apart.
Yeah, I think let's just jump in it apart. I think there's there's just some let's
yeah. All right. Here we go.
Hey,
let me know when you want to stop it.
Dave Ramsey, personality and financial expert. I'm also a millennial and social media aficionado. And I've been lots of terrible financial advice all over social media. And the one that keeps popping up is this thing called universal life insurance. Now, here's how it's marketed.
So it's actually, well, I mean, he's going to get to it. But again, there's a lot of contradictions here, and it doesn't seem like he actually understands how the product works, which is not surprising. I mean, it's a really, really complicated product anyways. But it's Index Universal Life that is being promoted so much on social media. And I would actually agree with him on this point that there is an incredible amount of terrible advice on social media right now. I mean, it's borderline egregious, Jeff. Like some of the stuff that I see on, I'm not on TikTok a ton, but we share it in the Discord channel a lot. And I still see it on LinkedIn. Oh my God, LinkedIn is just, I don't know if people are coming over from TikTok and getting onto LinkedIn, but some of the stuff that I see people post about IUL is unbelievable. I don't know how it's legal. I don't know how it gets past compliance and why these companies are okay with it. I see so many IUL agents saying that a 401k is a scam. and that you should put all of your money into an IUL instead. You can never lose money in an IUL. And this is what they're saying, which is obviously not true. And so in that sense, I would actually agree with George here. There is some really, really awful financial advice on social media out there that you really got to be careful. And I think the best way to do that is, again, to hear the other side of the story. Don't just take people's word for what they're saying at face value. I say it for my stuff all the time. Don't take what I'm saying at face value. Go do your own research. But when you hear this kind of stuff that I've seen on social media, it should really raise some red flags. Like if someone's telling you can never lose money in an IUL, oh my God. So what are your thoughts on that?
Yeah, I think I agree with you there. I mean, there's definitely, I've seen enough stuff on TikTok. I'm on there a decent amount, and different companies across the board, different agents that, spew all kinds of stuff that, they're probably a few months into the business, they were told what their upline told them to tell, and, they really haven't been in the industry that long to really know products, to really know strategy, to really understand things at a deep level.
Yeah.
And you're getting,
they're just spitting out talking points.
What's that? What's that?
They're just spitting out talking points that their upline gave them or whatever.
And there's a lot of marketing in there that's not really positioning things correctly, and it's really bad. It's shocked to see it done and that it's allowed. I kind of cringe at that, knowing that I'm in this industry. That is so you can, it's like the Wild West. You can just do whatever, say whatever, and there's no real consequences. Although I think they're coming.
Yeah, I sure hope so. And it's one of the reasons I started my channel. I wanted to share this awesome strategy, infinite banking with people. I'm doing it in my life, but also I almost purchased an IUL because of all the social media stuff that I was hearing about how fantastic it was, and nobody was ever really talking about the risks and all the things that can go wrong. And even when they did, they downplayed it so much. And when that's all you're seeing on social media, if you don't do your research and listen to the other side, you could end up investing, putting a lot of money into a product that you have very little understanding about, and it's not actually in alignment with what you're trying to accomplish. So you do have to be really careful on that. Want to anything else on that, or you want to continue?
No, let's keep it rolling.
All right.
You're supposed to use your life insurance while you're still alive, right? Everyone's like, investing all inside my life insurance. I'm going to become a millionaire. And they're always touting this crap as secret wealth hacks of the rich. No, hard no. Who actually predict?
So I do touch on that really quick. Secrets of the rich. I do think that is very, very overused to try and sell or to try and make IUL or sometimes even whole life insurance too seem like it's something that, hey, that the super wealthy are using this, so you need to do it too. Secrets of the rich. Well, I can tell you this with a pretty good amount of confidence that the super rich are not buying IUL. They might sell IUL, right? But they're not buying IUL. Like IUL hasn't even been around that long. I think it was the first. I think it came out in 1997. So it's really frustrating when I hear IUL agents talk about how the super rich have always used their life insurance policies to build wealth. And while that might be true for me, that's if you want to be wealthy, look at what the wealthy do, replicate it, according to what your goals are, and we should learn from the wealthy, right? But that doesn't necessarily mean that what they're doing is a good fit for us. Number one, but number two. These stories that IUL agents will use sometimes about Ray Kroc and the story of J.C. Penney, and you've heard all these different stories about the super wealthy using their policies. Those were whole life policies, not IUL, and IUL couldn't be more different from whole life if it tried. So to sit there and use the history of whole life insurance and how people have used it to now try and sell this other brand new product that the super wealthy are likely not using. I've even heard Garrett Gunderson talk about that in his book. He's confirmed it with super wealthy families. They don't touch IUL. Banks rarely touch IUL. When you look at all the cash value life insurance they have, it's primarily whole life insurance, right? So, I kind of agree with him on this, the concept of using just the idea that these are like the secrets of the wealthy. The wealthy are not using IUL, okay? Not in the context of what a lot of agents are talking about. So something to be aware of.
Yeah, for sure. I had a message come through that the audio is like reverberating or something. I don't know if it's picking up on your mic and then
let me try and mute myself. Let's see if that helps.
Okay. So yeah, let me keep talking. I can still hear myself. I don't know why I can still hear myself, even if you're muted. But
you can hear yourself on your end.
No, I'm not muted. If I'm muted, I don't know.
No, but you can hear yourself on your end.
Yeah, I can.
I wonder, maybe it's my mic. Let me see if I can. I'm gonna plug my headset in.
Okay.
Maybe that'll help.
Yep.
Let's try that.
All right, sounds good. Yeah, it's better. Yep, a lot better.
Is that better? Okay.
Cool. Yeah, so I think one of the things that I wanted to touch on was one of the things he said before he got into what the wealthy do. I think I want to take it back a step is this is an investment, and that you're combining a life insurance product with an investment, and that is not correct. And that is one of the things that I think is day one in the industry. Like, you understand that something that is guaranteed to go up in whole life insurance, there's no risk of loss, so it is not an investment. Investments naturally carry risk. So when you're talking about a guaranteed product that's always going to increase in value, or the appreciation there, it's not an investment. So then you have to ask, okay, if it's not an investment, what is it? Well, it's a savings alternative. It's a storage place for capital. It can be a bond alternative. So those of you that know any specifics about investing, there's a lot of top minds out there that have done a lot of research and number crunching to know that there's a general formula that, like in Tony Robbins' Money Master the Game book, is a 60-40 portfolio, 60% in stocks and 40% in bonds. And so there's a lot of great reasons to have that 40% in cash value life insurance and whole life, not IUL. And that is a way to go about it. But when you're looking at what is whole life insurance, it's not an investment. It is, yeah, sure. It is, would that work? I just do that?
Yeah, it's fine.
Okay. It's not an investment. So the fact that George here or anybody else is comparing it to that, to me right now is a red flag. Like, okay, they don't truly understand the product that they're either bashing or promoting or whatever, because it's not an investment inherently. And it fits into your financial strategy or your financial plan differently than what they're pitching it or positioning it to be. It's not we're trying to go earn this crazy rate of return and become this millionaire, like George is saying, off of life insurance. That's not the point. The point is a storage place for money. It's a safe, liquid, guaranteed place that I know that whatever money I have here is there. It's liquid, and I can use it for a couple things. I can use it to pay down debts, maybe, or I can use it as an opportunity fund. I can use it as an emergency fund. Something comes up, I need to access cash and not do it on credit and repeat the debt cycle. I've got that in cash value of a life insurance policy. Or if there's opportunities, I know you, Matt, are doing it for other outside investing. It's a way a lot of entrepreneur, multi-millionaire people will use these types of policies, is for the opportunity fund. They know that if they have a storage place for money and we go through an economic downturn, or depending on what their business is, and they want to pounce on an opportunity, they've got the liquid cash. They don't have to go to the bank. They don't have to go through the loan process, get approved, wait 30 days, 60 days, 90 days to get money to make a move in their business or towards their investments. They've got it within, 2 to 4 business days, typically, with a policy loan. So that is the strategy difference that we're talking about here. It's not an investment. We're not trying to become rich off these policies. It's for a different purpose. And you can still, within a good, solid financial plan, you can still invest. You can do that, though, in a way that aligns with your values and beliefs, and not just throwing money at the market because that's what we're told to do, and that's what everybody else is doing. You can invest more strategically, more in an educated way, which is going to naturally lower your risk. So if you want to get into real estate investing, or in a lot of times, and you and I have done content on this, investing in yourself. We did, I think the last time you and I did content, we spent a lot of time talking about the power of investing in yourself.
Yep.
And go watch that on our channels, because that's a really good video talking about that. I don't want to dive into that right now, but there's so many ways that we can leverage the policy to do the next thing to advance ourselves financially. We're not trying to just go crazy with money inside the policy. We're trying to have access to capital to go do more strategic things.
Right. No, I agree 100%. Sometimes I do argue that, like when I look at my policies that I've set up over the long run, I mean, it can build a pretty good amount of wealth. When you think about like the net 3 to 5% tax-free growth that it gets, I mean, is that sexy? No. Are we going to get super wealthy? off of that? No. I mean, the numbers, you compound money over 40, 50 years. I mean, that could turn into a pretty substantial amount of wealth. So I don't want to underplay that, but you're right. Like, we don't set these policies up and then just leave them alone and let them just get their 3 to 5%. We're talking about whole life right now. We're going to use we're going to use the policy to accelerate the wealth building process in our lives. It's an excellent place to store capital, set up an emergency and opportunity fund. You have the death benefit, living benefits in case something happens to you. Like it's such an efficient financial vehicle that, like, if you're going to have savings, if you're going to have large amounts of capital, opportunity funds, et cetera, why not put it in the most effective and efficient vehicle possible? For me, that's a custom designed, high cash value, whole life insurance policy. Now, with regards to what George is talking about here, investing, sometimes I would argue that IUL could be considered an investment because of its complexity and its potential for loss as well. You will lose money in an IUL when you have 0 years because there's still cost of insurance, other fees. God forbid you're taking policy loans for income. What happens when you've racked up a really large loan balance? You have 5% interest that's due on that loan balance. Where does that money come from? Right. So you can absolutely lose money in an IUL. And I would ask people, like, how much do you know about call options? Because that's what's happening here. All right. You're investing in call options. Now where I push back on George here a little bit, again, I just don't think he really understands how this product works. And it's funny because I can already see the comments of IUL agents like, well, you don't know how IUL works either. Everything you're saying is wrong, except it's not. But that's okay. Feel free to hop on the channel and tell me how wrong I am. But anyways, he's talking about, like, with an IUL, investing in these index funds and stuff. And that's just, you're not actually invested in the market. So I do want to make sure, again, that you have the right information here. What he's saying is a half truth. Okay. Because granted, instead of getting dividends like you would with a whole life policy, part of your premium in an IUL gets put into these call options on these different index funds, but you're not actually invested in the market. So that is really important to understand. And that's why an IUL is able to offer that upside potential, downside protection, because you're not invested in these index funds that he's talking about. All right. So again, it's just important, really important. Like, if you're considering a product like this, to do your research and understand how they work. And very quickly, you find that they're a lot more complicated. Like this IUL, they're a lot more complicated than people make it out to be. And they simplify it to the point where, like, people just come to the conclusion, like, okay, yeah, this makes sense. It doesn't sound too complicated. I'm getting this upside potential, downside protection. But then you don't realize that there's a call options budget involved. And then there's the cost of call options that's going to impact the performance of the policy. They can adjust cap rates and participation rates, spread rates, different volatility indexes. It's like and then you have to manage that amount of risk. You have to worry about rising cost of insurance. Once you start to realize all that, I mean, that was kind of a mouthful for me. And I've been talking about this for a while now. Like, do you really want to mess with something like that? The answer for me was no. So yeah, all good stuff there. So ready to continue?
Yep, let's do it.
Let's rock and roll. Want to go back to, you want to just keep it like this, or do you want to go back to full screen share?
Let's try it like this, see if it works.
Yeah, we could. I think this is fine. Maybe go ahead and do the full screen so we can see, like, there we go.
Audio's not coming through on my end.
It's not coming through on your end?
Nope.
For the video?
Correct.
Okay, I'm gonna have to for now.
Yeah, whether it's a smart or a money.
There we go.
How's that?
Yep, I can hear now.
Let's start by defining index unified funds. That is a mouthful. Based on that name alone. Let's give this guy anything. We'll call him IUL for. Okay, sadly that's still just as annoying. Anyways, IUL. It's really sophisticated, nuanced. It's so complicated. You don't understand. Just to me, bro. I'm your insurance guy. I'm gonna make lots of money, kind of thing. Gross. But it really just puts a new spin on an old and terrible idea.
Jeff, hang on.
It's like breaking up a little bit. Are you hearing that on your end?
I'm good right now. Is that better?
It's still froze on my end. It was just like he
Well,
was.
no,
It was
I
almost like
paused
a
the video.
Yeah, but it was like the video was. It was like garbled, and then he would like catch up and go good, and then it would like garble again. Was it doing that on your end, or is it just coming through
No,
Restream? No, bummer.
no, it's good on mine. I can go back if you want. I'll go back a little bit.
Try. Yeah.
I was gonna ask you because he's talking about like insurance agents. Just trust me, bro. We're gonna make you a lot of money and blah blah blah.
Mm-hmm.
And I was gonna ask you like your thoughts on like I don't like this argument that people will make about life insurance agents, how they're just sleazy salesmen, scumbags, just trying to make money off of people. And it's like, look, in finance, any type of financial services, any type of financial product, there's commissions involved and whatnot. So my question to somebody like George is, what's the difference between a financial advisor selling complicated products versus an IUL agent selling an IUL? Now, again, I'm not a fan of IUL, but like, why do people like, why do they make this argument that it's the only reason people get into life insurance is to screw people over, right? And make a bunch of money off of them. Like financial advisors make a crap ton more money on their clients than life insurance agents do. Maybe not up front, but and then also the argument, or I guess the question would be too, are there not scumbag financial advisors that sell complicated products and they just say, oh, just trust me, put all your money into this, and in 30, 40 years, you'll be fine? So where's that argument coming from? I've never understood that argument.
Yeah, I'm not sure either.
Why it's relevant to the conversation.
Right. I mean, I think for me, as you said, I think we did a video like on this topic down in the Dominican together. We were down there for the mastermind in April. Like, it's funny to like take one segment and bash the whole life insurance agent for a set of talking points when it's actually worse for the other side that you're on. Like, that doesn't make any sense to me. And I think when you really get down to it, I found no matter what the profession is, if it's a roofing company, if it's a construction company, if it's a doctor, it's a acupuncture, like whatever profession, there's usually a very small percentage of people at the top that you actually want to hire for yourself, right? There's most everybody out there is cutting corners, not doing as good a job as you would like. I mean, that's just kind of the human nature. Like, there's a top 20% that's doing things really, really good. Then there's like the bottom 80% that, it's like it's called the 80-20 rule for a reason. And I think, the top 20% of financial advisors are really good. They're doing the right things for their product or for their customers, get them into the right products. It's not about the money. They've really, that self-education is a big thing for them. They know their stuff inside and out. They know when certain products are the right fit for certain strategies. But the same thing goes for guys like us that have been in life insurance. Like, we didn't get into this to become a life insurance salesman. There's a deeper reason behind it. And I know we've talked about that before too. And, again, I've been around this stuff. I've been around alternative finance and studying it long before I started selling it, like a decade. I mean, a long time. I've been really immersed in this for a long, long time to understand things at a deep level. And I consistently go to the other side of the fence and try to understand the other side. And what are the talking points? And is there a better way? And where does one strategy fit in? And where does another one fit in? And like, there's a certain top percentage of us guys that function that way. So it doesn't matter what your title is, what your degree is, what your certification is, what your licensing is. It really just you have to find the right person that's going to do the right thing by you. And I've had a number of clients that they have traditional financial advisors, and they're exactly what George is saying about the life insurance guys. They're product pushers. They don't educate. They don't inform. They don't take the time. They're doing things in a really, in my view, a very bad way of going about it. And it's not optimized for the client. It's optimized for their pocketbook and their long-term commissions. And like you said, yes, we get, as life insurance agents, we get upfront commissions. But guess what? If you compare that apples to apples over a traditional financial advisors are making a piece of your growth and your or not even your growth, your assets under management for as long as they have it. And they're also making that fee on the portion that's the government's, the taxable part that you'll never get. They're getting that fee. So, if you really want to, throw shade somewhere, let's look at both sides. Let's evaluate. Let's really educate a client and not just say, again, a half truth. This is what's so bad about this side, but over here, they don't do anything wrong. And because they've got this title, you can just take everything at face value. You don't have to do any due diligence because you know everything that comes out of their mouth is perfect.
Right. Yeah, exactly. No, I agree. And I just think it's really an irrelevant part of the conversation. It's useless. It doesn't do anything to advance the knowledge and education of the product itself so that the people can make their own informed decisions. Just saying like insurance agents are bad because they're going to make a bunch of commission. Well, I could say the same thing about financial advisors. Just going to sell you stuff to make a bunch of commissions. Like, and then now that's just not a productive conversation at all.
Right.
And you're going to have bad apples, like you said, in every single industry. But that's why, as a consumer, it's important to understand what you're putting your money into. Again, you don't have to be an expert, but you have to know the right questions to ask, the right things to look at, so that you know you're not working with one of those bad apples. Right? Being an informed consumer, I think, is what helps separate that and keeps people safe. Is doing your education. And also, I have a problem with like the commission aspect of it again, because financial advisors make commissions, like any type of financial service, your stockbroker makes commissions. That's okay. Like that's just because somebody makes money doesn't mean the product is bad, or like, and also like, I think he mentions like why it's IUL so much more expensive than term is because of all the commissions and stuff. Well, when you say expensive, that's very subjective. Right? Like we have to look at not the expenses. What's the value that we're getting from this? Because you could say that whole life insurance is way more expensive for the same amount of death benefit than it would be with a term policy, and you would be correct. But if you just stop there, you're missing that. That's just the tip of the iceberg. You're missing the whole point of what we're trying to do here. At least in my case, when I set my whole life policies up, like
Yep.
Okay, so yeah, I don't get as much death benefit as I would with the term policy, but what value am I getting for that expense, for those costs? Well, the value I'm getting far exceeds any expenses that I pay, and the lower death benefit that I have, which I still have a term policy on top of my whole life policies, so I still have a massive amount of death benefit. But my point is, like, when you hear, oh, it's just for the commissions and the agents are all bad and it's really expensive. Like, again, what is this person trying to push onto you? Because they're not educating you about the product. They're just bashing the people selling it and the compensation structure of it. Like, that is not productive, in my opinion. So it's just something to be aware of, guys. Like, when you start hearing this kind of crap, I'm not saying that you shouldn't point out that there are bad apples in this industry, right? You do have to be careful. Because I see it all the time, Jeff. So I don't disagree 100%. But when it comes to making the decision for yourself, is this a big factor that commissions get paid and insurance agents versus financial advisors? Like, that's not productive. That's not going to help you. At least not for me. That was not anywhere. That was not associated with my decision to move forward with a policy at all. So,
Yep.
Good stuff.
Totally agree.
I backed up a little bit. Let me know if I'm going to unplug again so you can hear the audio. Let me know if it continues.
I hate it based on that name alone. Let's give this guy a nickname. We'll call him IUL for short. Okay, sadly, that's just as annoying. Anyways, IUL gets pitched as this really sophisticated, nuanced, it's so complicated, you don't understand, just trust me, bro, I'm your insurance guy, I'm going to make you lots of money, kind of thing. Really gross. But it really just puts a new spin on an old and terrible idea. And that idea is whole life or cash value life insurance. It's where you have an investment account and a life insurance policy rolled into one product. And it's something I never recommend because it tries to do two things at once and ends up sucking at both and costs way more than term life insurance.
Anything on
All right,
on
pause
that?
it. All right, pause it. Yeah.
All right.
All right, two things on this.
Floor's yours. How about it?
One of them I'll get to in a minute. I'm going to switch share screen here in a minute because I pulled up an illustration that I ran for term life insurance that was for a client. This isn't I'm trying to like finagle something. I'll do that in a minute. But this whole idea that whole life tries to do multiple things and sucked at both of them. You're trying to be insured and you're trying to have an investment account. And we already touched on the investment part earlier in the conversation, so I won't re-hit that. But the idea that, it sucks at both. Well, it doesn't suck at both. It actually does more than two things, George, and it actually excels at them. There's so many things. This is, Caleb Williams calls it the and asset. Other experts in the space show this as being the most flexible financial asset you can have because it
Whole
serves
life, we're talking
multiple,
about, right?
yes, whole life, yes, exactly.
Yeah, not
Whole
IUL.
life, cash value, whole life insurance, dividend paying whole life insurance serves as so many solutions across the lifetime for someone and even beyond as legacy planning that no other asset or financial product can do. It does so many things, from being an alternative or a supplemental alternative for college planning. It can help you get more scholarship or loan money for your child because you're showing monies that's not going to be put on the forms for you to fill out to turn in to show what the household income is, right? That's a strategy. There's strategies for tax-free retirement. It's going to help your other assets perform better in retirement. And I could go on and on and on. There's probably a dozen or more gaps in a normal financial plan or ways that this product enhances everything you're doing financially, that it does do multiple things really, really well. And that's why we use this, because it's called financial efficiency. We want $1 doing 2, 3, 4, 5 jobs at one time, because that means we don't need to have 3, 4, 5 different professionals or 3, 4, 5 different accounts to do those same functions. If we can put dollars into one place and they're doing all those same functions at the same time. So on that point, I agree with George. It doesn't do investing good because it's not trying to do investing,
Right.
but it does do other things extremely well. And that's why it's a foundational asset that we utilize.
100%. And where he's just mixing things up is, I mean, he's really talking about a variable universal life policy, not an IUL. Just to be fair to the IUL here, right? Where like the VUL is actually where they're combining the term life insurance with investing. It was an absolute disaster. People got wrecked, just like they did with regular universal life policies, which and a lot of people are getting wrecked already with indexed universal life. So I don't know how many times we have to keep trying to make this broken chassis work, but whatever. Again, it's just important to understand the difference. And I agree where, like, when you're trying to combine life insurance with investments, I don't think that's a really good idea. But, he mentioned earlier, taking this terrible idea of whole life cash value life insurance. Okay, well, now, wait a minute. We're talking about apples and tater tots now, because it's a completely opposite different type of product, where whole life, you're not combining life insurance and investing. It's just whole life insurance. And it just happens to be a very efficient vehicle that allows you to use it in so many different ways. And I'll just finish up with this, Jeff, and we'll get into the illustration there. I definitely want to see the numbers there. But I go back to, it made me think of, like, when you're bringing up the different things that a whole life policy can do for people. It reminded me of an illustration I was going through with a client of mine that he's going to be setting up a policy for his daughter. And she's 3 years old, which is, like, I mean, one of the best things you can do for your kids financially is setting these things up early. And what we did is we went through the illustration. We just broke down the different parts of her life, like major financial decisions, major decisions in general, where the policy is going to be there for her, that a term life policy would never be able to do. And IUL, again, IULs don't really have problems in the beginning, if assuming you're funding it properly. Later on is when they really have the problems. But that whole life policy, it's not just life insurance. That is going to be there for her when she's ready to buy her first vehicle, when she's ready to go off to college, when she's ready to start a family, buy a house, eventually, to retire. Like, it's going to be there through all of those main timeframes throughout her life, all those big decisions. And I just don't know, like, when you see something like that, how can you call that crap? How can you call that trash? Because it's so powerful, it's so efficient. And not to mention too, the death benefit that because the death benefit is growing with the cash value over her lifetime. We're talking about over $10 million in death benefit. It was like closer to $15-16 million death benefit that we passed on to his grandkids. So her kids, his grandkids. Now we're talking about building a massive, massive legacy. Can you do that with term life insurance, which is what he promotes? Can you do that with buy term and invest the difference? I don't know. Maybe you can make an argument that you could. I just know that with whole life insurance, you set these things up right, it is guaranteed to be there. We don't need to worry about what the stock market's going to do, cost of insurance, net amount of risk with IUL, blah, blah, blah. We don't have to worry about any of that. Whole life, you see is what you get. So what you got for us on?
So this is a illustration that we ran for a client about a month ago, and
Jeff, can you make it a little bit bigger, like maybe adjust our?
Let me see if I can. Does
adjust
this
our angles?
make it?
Yeah, and maybe are you able to zoom in a little bit?
Zoom in over here on
there
this.
we go. Yeah. There you go. All right, cool.
There we go. Okay, cool.
All right, what you got?
So this was on a 51-year-old male. He wanted a couple $100,000 of death benefit, and we were looking at what makes sense for him. So annual premium here is the $679, and then there's the accumulative premium. So every year's premium added to the years before, right? And so this was like 50. What would that come out to be? $58 a month or something like that, I think was the premium. So, what George said there, the last clip just before we paused, the term life insurance is so much cheaper. And this is what does drive me a little bit crazy about anybody that's pitching this, is because they're looking only at the first set of term. So like in this case, it was a 10-year term. You could get 20-year term, 15-year term, maybe even longer. And that first 15 or 20 would all be this really low number. But because it's so disproportionately low on the front end, they're going to make up for it in all the subsequent years. So this strategy comes into place, let me give a little context to this, is the whole idea of you invest in the term, you're putting money in term because you're going to invest in the stock market with the rest of your money that you're saving from whole life. If you're buying a whole life policy at $200,000 of death benefit, let's call that difference, maybe $2,500 a year or something like that. I don't know if that's the exact number. It would vary depending on age and different circumstances. But, instead of $680 per year and $2,500, you put that difference into the stock market and you'll have millions and millions of dollars by the time you retire, and therefore you're self-insured. Right. And so the two things that I always come back to that on is, okay, well, what happens if life doesn't go perfect, where all the money that we were going to invest, maybe we couldn't, maybe life happens, maybe we have health issues, maybe we have a job loss, maybe we have, you're hit with a slew of car problems. I know I've had a lot of goals in life, and guess what? I don't think too many of them have occurred in the time frame I thought on the front end it would occur in, right? Sometimes life doesn't go as we think. So instead of planning for the best case scenario, which this scenario does, where you only need this cheap term policy in the very beginning because you're going to have so much money later on that if you do pass away, your assets will basically be there to replace any income needs that you have or serve as that legacy transfer like you just mentioned, Matt. So then the second point around that is, okay, that works on paper to have this, multi-million-dollar portfolio, but is that the most efficient use of a massive portfolio to do income replacement or to serve as a legacy transfer? Because in either case, there's taxation that's coming out of that stock portfolio, right? So it's automatically going to go down by 30 to 40% if you're trying to do like a massive withdrawal to replace income or to be a legacy transfer. The government's going to get their cut, right? So that's a problem that doesn't fit into this. Whereas a cash value whole life insurance policy, there's going to be the death benefit's going to go there, and you're going to have obviously access to the cash value all through your life. And George will make a point here at the end about the cash value doesn't go with you, which we'll probably expand on at that point in the video. But this is really what it comes down to is, yes, it's cheap in the beginning. It's $680 for the first 10 years. But look what it does in year 11. It goes from $680 to $4,100. Yeah. So therefore, it no longer becomes this cheap term policy. And there's a lot of people, I read Dave Ramsey comments sections all the time on Facebook. There's a decent number of people that are like, my term just expired. What do I do now? Because now it did just this. It went from $600 to $4,000. I can't afford it now. Now I don't have my coverage. So you really want to bet the cards that everything's going to go really, really well in your life and plan for best case scenario? Or would you rather have a strategy with whole life insurance to where you're not going to be put in a worse position at a later point in your life if everything doesn't go right? And I can't now afford this term life policy because I still need it. Still need to follow Dave Ramsey's advice. I still need my income replacement because I don't have my assets built to where I want to. Right. But now I can't afford the insurance. And what happens if I pass away? Well, that puts the family in a really big pickle. And I have a really hard ethical problem with that, advising people, because there's a certain segment of the audience that's going to fit that exact scenario I just laid out. I don't know if it's 10%, I don't know if it's 20%, but there's guaranteed going to be a section of his audience that can't afford it. And I think with the way the economy is going, it's probably a bigger number than I said, 20 or 15, 20%. It's probably higher than that people can't afford the higher number. And then that puts people at a real financial disadvantage and really harm people. It could mean bankruptcy for people. It could mean losing a house. I mean, it could mean some serious things to where, is there a better way to go about this? And that's where we feel like absolutely there is. Yes, it's not as cheap on the front end, but long term, there's many provisions where you can keep your coverage with permanent whole life insurance. And it can be whatever money you've put into it. It's actually grown more than that. So you're always at a net positive. And there's never a time in term life insurance that what you've put in, you've got something of an asset that's higher value than what you've put into it. With term life insurance, you're always behind the 8 ball. And one point I want to point out here, I don't know if I can zoom. Yeah, I can zoom down. Look down here, guys, at age 77. So this is the 27th year of the policy for this individual that ran. The cumulative premium goes from 193 to 220,000. So if he paid for this past that first cheap 10-year term, there's a point where you've put more into it than you'll ever get back out of it. So mathematically, what is the point? Right. That never happens with whole life. There's never a point where you've put in more than the death benefit. And that's just one of the few things on that. And, it's staggering to me to look at a chart like this. And this is from Lafayette Insurance Company. I'll be totally transparent on what this is. And it jumped from
it would be very similar across all companies. Yeah, this is just
exactly
how it works.
Yep. But I mean, look at this down here, guys. I mean, when he was 90, the premium, all the cumulative premiums, a total over $1 million, 5 times the death benefit. And I know most people aren't going to get to that. It doesn't make financial sense. I get that, but that's just the trajectory around where you're paying. Look at this. This is going up by like $2,500 a month in your 70s, on up to where a premium at 85 is almost $63,000. Like, that's just insane. And I know most people would never carry the policy that far, but I mean, Matt, we've heard stories of people in their 90s that are trying to still make something like this work, maybe even on the IUL side. And even on IUL, it doesn't mathematically make sense for them to retain the policy because it's so expensive. So love to hear your thoughts on all this.
Oh man, there's 1,000 different rabbit holes we can go down on this. So a couple things really quick before I get into the term premium. I'm really glad you brought this up because this is going to tie in perfectly to the IUL also. Here's the thing, is like a big selling point of the buy term and invest the difference. You buy term because it's cheap. Again, cheap isn't always good. Now, I want to be clear. I'm not saying that you shouldn't do, this is not financial advice. I'm just sharing my thoughts. I think Jeff is too. This is not financial advice. If buy term and invest the difference makes sense for you after you've explored all of your other options, maybe that is right for you. But I think the problem, Jeff, is I think you'd agree with me, is that buy term and invest the difference is just shoved down people's throats, and they bash all of the other options when in reality, those other options could be much better, much more beneficial for helping people achieve their goals, right? One of the things that people often overlook, especially people like George and Dave Ramsey, is the living benefits that you get that, like, I don't think people think about the massive amount of cost that medical expenses, long-term care is going to have later on in life. And is your retirement portfolio going to be able to sustain that? Maybe. I mean, if you get the 12% every single year, like Dave Ramsey tells you you're going to get, then maybe you can. But now you've got a retirement portfolio that you have to manage. Hopefully you have a volatility buffer. But what happens if the market goes down 20% when you're taking withdrawals? That's going to significantly cut into how long you can withdraw from your portfolio if you don't have that volatility buffer. Not to mention, it's providing your income. What happens, like you said, Jeff, if life happens? What happens if you fall down a flight of stairs, you get into a car accident, you get sick? Like we all get sick at some point. What is your plan for that? And are you relying on your stock portfolio for all of that stuff? Well, I personally think you're going to have a really hard time if that's what you're doing. And that's so important to explore these other options. So cheap is not always better. Like if I were to go to a dealership, right, and there's a $3,000 junker over here, but right here, but then there's a brand new, F-150 for $30,000 or whatever, right? Well, if we're only using cheap is better, like you buy term because it's cheaper than whole life, if that's all the only argument that we're having, well, then I would buy the clunker every single time, even though it's not going to serve me in the long run. There's going to be a lot of problems later on down the road versus if, so this F-150 over here for $30,000 in this example is more expensive, but what's the value that I'm getting for it? Okay, what am I trying to do long term here? That's what I'm really trying to get you guys to think about here. What is the value that you're getting from this? If you see the value in buy term and invest the difference, do it. I don't care. I just want you to know what your options are. And to tie this back into IUL, Jeff, is so here's the thing. You were talking about like because the idea behind the buy term and invest the difference is that you're going to be self-insured at some point, which that's a whole other video that we'll do. But with term, so like when it stops there after the 10 years, and then it jumps to $4,100, people are not going to likely going to continue with that. They're going to let the term policy just expire. They no longer have the coverage or anything. Hopefully their stock portfolio is doing really good, whatever. All right. Here's the thing though, with IUL, you are keeping it every single year.
Good point.
This right here is a very good example. Or just, I guess, a demonstration of how annual renewable term works. Okay.
There you go.
Cost of insurance goes up every single year exponentially when you get older. I mean, look at go to 80 years old, Jeff. You're in this example. I mean, everybody's different with age, health, amount of death benefit and stuff like that. But at 80 years old, he would have $33,000 in cost of insurance potentially. Now, the difference with IUL is that what that cost of insurance formula gets applied to is what's called your net amount of risk. So the net amount of risk would be like in this case, he's got $200,000 in death benefit. Let's say this was an IUL and he has $180,000 of cash value. Well, the net amount of risk is $20,000. So you're only being charged for that $20,000 of death benefit in that case. But again, you're like I think you said it perfectly, Jeff, where people are setting things up, they're preparing for the best case scenario. Well, what if that best case scenario does not work and your net amount at risk is $100,000, $200,000? Like the net amount at risk is much higher than you anticipated because the market did not perform the way that it needed to in order to grow your IUL every single year, like they show. Huge red flag. Like what happens in that scenario? How are you going to cover your cost of insurance, right? That is something to just be aware of. Again, when you see this and you're okay with it, whatever, and you still want to do it, fine, roll the dice. But your cost of insurance goes up exponentially every single year because IUL is built on annual renewable term, guys. It renews every single year, which is exactly what you're seeing on the screen right now. Okay, is how a demonstration of how term insurance works. It gets more expensive, and that can potentially be a major issue later on down the road with IUL. So I wanted to circle it back to IUL, since that's what George is talking about, and I think this was a good demonstration of it. So yeah, term insurance, does it serve a purpose? Absolutely. I would always say, like, it's, if you can't afford a whole life policy, Jeff, I mean, we often say to people, like, start with a convertible term policy, right? So that way you have the coverage, you locked in your insurability. Do not take your insurability for granted, guys. All right. I've had this conversation with a few people now that, man, if they had set these things up earlier, they'd be good, but health problems, things happen. Like, do not take that insurability for granted. So term insurance absolutely has its place. But again, if we're thinking about long-term here, which with buy term and invest the difference, you're thinking long-term anyways, like what's the best way long-term to get to my destination, right? To reach my goals. That's what you really have to ask yourself, guys. Is it buy term and invest the difference? Is it an IUL? Is it whole life insurance? Is it nothing? Or you're just going to store your money under the mattress? Whatever works for you. You just got to know your options. So.
Yep. Cool. Let me bring back up the video and we'll keep rolling.
Cool.
This way.
All right.
This way.
But more on that later. With IUL, you're specifically investing into index funds, hence the name Index Universal. Even if you're an investing rookie, you've probably heard of the stock market and some of the most popular indexes, like the Dow Jones and NASDAQ, with those little green or red arrows on your TV screen. Well, with IUL, a chunk of your monthly premium gets invested into index funds. Now, don't get...
I'm not gonna harp on this too much. I have to clarify this, guys. You're not actually invested in the market. You're not actually investing in the index funds with IUL. I'm not a fan of IUL, but I want to be fair here. He's not explaining the product correctly at all. You're investing call options in the index funds, like all these different index funds, whatever that you can choose from. And that's very different than actually being invested in the market. I just want to clarify that.
Yep.
Don't get me wrong, I'm a big fan of investing in the stock market when it's done right, but this isn't one of those times. And don't even get me started on why investing with your life insurance agent instead of, an actual investment advisor is a bad idea. And here's the real catch with IUL. Your return on investment...
Yeah, go ahead.
So again, we touched on this, but I want to hit it here as well. He's positioning it, and I see a lot of Dave Ramsey ads this way as well, that Ramsey followers want to work with a real financial professional, right? And it's again this knock on, like, if you don't have this qualification, you're not a financial planner, then you really don't know what you're talking about, and you're below everyone else that is this, and it's what I said earlier. Like, you can find really good financial advisors, you can find really bad ones. I've had clients that have had some really poor ones. I'm working with one right now that's not very, education wise, not doing the right thing by the client. I've had some strategy calls, and hey, the advisor asked this, what about this gap? What about this strategy when this happens? They look at you with a blank stare, like, well, I don't know. My advisor's never said that to me. My advisor's never asked that. Well, how would I, as a lowly, life insurance agent, know to even ask that question when a financial advisor who's much more all-knowing and educated than I am, why would he not be saying that? So again, I don't like that positioning. Like you said, Matt, it doesn't serve a function. To me, it's more of a scapegoat, throw shade to try to make yourself look elevated and try to position yourself superiorly than someone else. But at the end of the day, you're not like really comparing what needs to be compared. You're not talking about what really truly needs to be talked about.
100%. Could have said it better myself. All right, let's continue.
Below the actual performance of the index. Why? Well, because the commissions and fees your agent makes by selling this crap are insane. And guess where those fees get taken out of? That's right, your investment account. Sound too bad to be true? It isn't. And as you get older, the cost to insure you can start wiping out your entire premium every month. Okay. And that means network. So
let's hit on that really quick. Again, you're not actually investing in these things. I don't know why you keep saying that. The commissions, like, you make commissions up front. I mean, and they can be really big commissions. It depends on how you structure it. Like the way we structure our whole life policies, where we're going lower death benefit, higher cash value, which translates to lower base premium, higher paid up additions. We actually take a pretty massive hit on our commission. All right. So that's number one. Number two, again, like what's the drag of that 1% to 2% management fee on a portfolio over the course of 30, 40 years? How much does that cost you? Right? That
50% of your balance, what Garrett says.
Very, very significant amount of money. Now, is that bad? Not if the financial advisor is performing and your account is growing. Again, it's all relative. What's the value that you're getting? So one is not better than another. It's just a useless part of the conversation. But he mentioned that the cost of insurance can really drag on the performance of your policy. That is absolutely true. It can. I'm not saying it always will, but that's what I tell people when I'm explaining IUL is you have to manage it like a hawk. You have to manage your net amount at risk. It's not a financial product where you just you put your money into it. You make your premium payment every single year, just bury your head in the sand, and it's going to be fine in 30, 40 years. That is absolutely not the case. If you don't manage your net amount at risk, your cost of insurance can absolutely destroy your policy, and not even necessarily lapse it. But if you were expecting, let's say, $1 million of cash value by the time you're retired, and you're expecting $50,000 of income every single year, whatever, but that doesn't happen. Let's say you only have $500,000 in cash value. Now you're only able to get $10,000, $20,000 per year in income. Well, if you made plans around that original illustration and it didn't do what you wanted because you weren't managing it and the cost of insurance started really putting a drag on the performance of the policy, what are you going to do? Are you prepared for that? Right. So I did want to touch on that because that can absolutely be the case. There's ways to manage the cost of insurance and net amount of risk, but for me, it's just not worth it. So anything on that?
Nope. Keep rolling, man.
Cool.
The investment side of your policy. The insurance company will even start dipping into your investment account to cover the cost of your premium.
Not investment account, your cash value. Big difference. Stop saying investment account. Unless you're going to make a video about variable universal life, stop saying investment account, George.
You've got a real money-eating monster on your hands. With IUL, the two good intentions of life insurance and investing can end up canceling each other out. Imagine paying a ton of your hard-earned money to an insurance company every year for the rest of your life. And if you actually want to use any of the cash value in your investment account, you have to borrow your own money and pay back with interest.
Oh, man. Gotta touch on that because that applies to whole life insurance as well.
Yep.
Oh, man.
Sure.
Jeff, are you when you take a policy loan, are you borrowing your own money?
I am not, Matt.
Then whose money are you borrowing, Jeff?
Well, let's see. I think I'm borrowing the insurance company's money because I have collateral with them in the form of a policy, and they're willing to do that because I have that collateral, and they like to do lines of credit for various reasons.
Now, why would you do that though? That just seems like a scam. That's just stupid. Why would you pay interest to borrow money like that?
Yeah, why would you pay interest to borrow someone else's money when you've got your money growing? Well, we can do some math on that, right? So if you have an asset that's appreciating, your cash value is growing at a guaranteed rate plus dividends, that growth typically, I mean, there's some outlanding scenarios where that always doesn't hold true, where the growth is going to grow more than whatever your interest costs are. And that is one of the primary reasons why you do this, not why you don't, because you understand some deeper financial truths. Like, to me, the difference between financial literacy and wealth literacy. Financial literacy says don't go into more debt, don't take a policy loan, don't borrow your own money, as they like to spin it. Whereas wealth literacy says, okay, if I have money somewhere and I'm getting a guaranteed uninterrupted compounding growth out of that, that's going to grow into something substantial over time, right? And again, it's not to compete with investments. It's about where's my safe, liquid, active capital going to be stored, and can I get that to perform pretty well? And honestly, there's times where that cash value growth can outperform the traditional stuff. It's not the way we market it, it's not the way we position it, but it can happen. It definitely can happen. So when we have that going on, we also have this ability to do a policy loan. But if you were to do it the way they're suggesting, where you would normally, have a savings account or have money in a 401k. I mean, I've had calls recently with some people that they think that this is really a bad idea, like George is saying, but they've taken, thousands of dollars out of their 401k. And we pointed out to them that, well, when you withdraw out of a 401k, did the money in there continue to grow? Right. And they're like, well, no, I took it out. I'm like, exactly. That's why we like to keep money in, because it's going to grow. The problem with a lot of the traditional ways of thinking is you interrupt compounding, right, which means you interrupt the potential of what that money is going to do for you in the future. And that is a big, powerful principle that it does make mathematical sense for you to keep growing your pile of money and borrow against it to go do something that's going to. And here's the thing, we had a client call last week where the person was really challenging us on why would we want to do a policy loan? It's like, well, you either have higher interest rate debt that you can save more than the cost to borrow, which is usually about 5.5%. Yep. So you're saving 30% on credit cards and only having to pay 5% for that, which is 25% net gain. So, okay, where else are you going to get 25%? That's going to be a immediate impact on your financial, bottom line. Like, that's significant. Or places you can go confidently earn more than 5%. So that is something called arbitrage, which again is a wealth principle. It's no different than if I went to Sam's and bought a 48 pack of bottled water, and it was 50 cents per bottled water there. And I went to a football game, a high school football game on Friday night, and sold those bottles of water for $3 a piece, right? I make the spread. I make the difference. I make $2.50 per bottle, right? And if I did that every Friday night for the football season, I'd probably come out pretty far ahead. Maybe I can contribute that to the boosters or something for the school, right? That's what we're doing with cash value life insurance is you have an appreciating asset. You can borrow against it. And if you're so confident that the stock market or your mutual fund is going to get you your 12%, well, why not gain 5%, 3 to 5% inside your policy that's going to grow, and then get your traditional stuff growing at your 10, 12% if you're so confident in it. And then you're making money in two places. And yes, you've got the interest cost in between, but if you only did investing in the stock market versus you put money in the whole life and did the stock market investing, which is a strategy. I'm not recommending you do that. It's just a strategy you can use, that you're further ahead because you're making money in two places with essentially the same dollars in effect. And that's just a better way of going about it. Now, I don't, when we work with clients, I don't like to position that for clients because if they're mismanaging money, if they can't handle the debt part of the policy loan, it's not for them, right? It's for somebody that is a good saver. It's somebody that's financially responsible. They get the whole process, the whole financial picture with these moving pieces, and they know how to responsibly manage it. If somebody's still caught in a debt mindset, they're just going to bury themselves with this instrument, right? So you don't want to do that. You have to be at the right place at the right time, mentally and your financial habits to make this work. But I mean, those are my thoughts around it. What are yours, Matt?
Yeah, a lot of thoughts on that. I'll try and condense it. I've done a ton of training and videos on this on my channel, guys. Make sure you check it out. Like actually looking at the numbers, breaking down the numbers. One of the things you mentioned, Jeff, was people taking out money from a 401k and interrupting that compound process. And I just don't think we're not taught to really appreciate the massive, massive negative impact of lost opportunity costs and interrupting that compound process in our lives. We're not taught how significant that is. And I've run the numbers on this. When I purchased my vehicle, before I paid cash for it, I put the money into my policy first, because now that money is going to grow for me forever. And now I borrow against it, pay cash for the vehicle, and that money is continuing to grow. When I ran the numbers on that, Jeff, just at 4%, just going in the middle there, 3 to 5% is typically what these policies will net after fees and everything, costs, whatever. All right, just at 4%, that $28,000 over 40 years turns into almost $135,000. So I basically put back over $100,000 into my empire, my life, over the next 40 years by simply, all I did was change where the money went first. It's one of my mentors, Chris Noggle, talks about all the time. All you're doing is adding an additional step, changing where the money goes first. And that is putting it into a policy. The other thing you mentioned is about interest rates right now. I consolidated my mother's, all of my mother's credit card debt. She was paying 25, 30% interest on like 11 different cards. We consolidated all of that into one policy loan that she pays back with a little bit of interest. The current loan rate is 5.5%. So my question to people would be, would you rather pay 25%, 30% interest on credit cards? Or would you rather take the money that you're using to pay off the credit cards anyways, put it into a policy first, borrow from it, because now that money is going to continue to grow. But now you start to pay off these credit cards and your loan interest rate is only 5.5% versus 25% you're paying on the credit card. How does that not make sense? What am I missing here? Right? I know that like with business owners right now, with interest rates being really high, having access to different lines of credit and financing and capital and stuff, it's pretty expensive. I've had conversations with people in that industry that help with business funding and financing for companies. And the interest rates are really high. So if you're in business right now and you're paying 10% on your financing right now, well, what would the difference be to your bottom line if you're only paying 5.5%?
Yep.
Not to mention that your money is growing every single year, and these things get better and better with time. All right. And I'll finish up on this point with this section of the video here, Jeff. I'm doing my first private money deal very soon, and I'm borrowing from my policies in order to fund that deal. Right. So I'm actually acting like the bank now, where I'm borrowing at 5.5%. I'm going to charge 12% over here. And yet my policy is going to continue to grow. Well, I'll tell you what, over the next 4 to 5 years, as my policy continues to grow, like just in year one, my policy is growing by more than the interest cost to do this deal. So I'm already in the net positive on that. But when you look at 5, 10 years down the road, when these things really start to ramp up and get more efficient, oh my God, your policy is growing by far more than the interest costs that you are paying. And you can't just look at the growth rate versus the policy loan rate. Like let's say my policy grows by 5%, but I'm paying 5.5% on my policy loan. Okay, well, there's a very big difference between those two interest rates, because my policy is compounding versus the simple interest that I'm paying on the policy loan. So when I broke down this current deal that I'm doing, the interest, my policy grows by almost twice as much as what my interest cost is going to be. Mm-hmm. Plus, I'm making money on the actual private money deal. What am I missing? How is that bad? What about that does not make sense? I love the way you put it, wealth literacy. I was thinking Dave literacy as the opposite, right? But when you start to understand this kind of stuff, that's exactly what banks do. When we put money into a bank account, but it pays, let's say it pays at 2% right now, whatever, and then they lend that out at 7%. Do you think the bank is complaining about, are they stupid because they're paying 2% to us to use our money to lend out at 7%? No. They're making 5 points of positive arbitrage there. That's hundreds of % return that the bank is getting in that scenario. So why, if we have the ability to do that, why wouldn't we? Right. So I'll finish up with that.
All right. So we're talking about this. I'm I want to put some numbers to this. I know we've done this in presentations before to show, the power of what we're talking about, where you have interest cost, yes, but even a higher interest rate on paper that you're paying, you're still further ahead, even though you're earning a lower interest rate on paper, because you have an appreciating asset versus usually a depreciating asset, which is when you're paying off a loan, the balance goes down. So let me show this real quick. So this is an amortization calculator on the calculatorsite.com. Anybody can go do this. I ain't playing any funny games. $5,000 loan amount, 5% interest for 6 years. Let's go down to the table here, and it shows. So the orange column here is the amount of interest you're paying. $215 in year 1, $199 in year 2, $159. You see it goes down by the third year. It's 33 cents all you pay in interest in that time frame, right? So let me switch tabs. So this is a compound interest calculator on the calculator site. Starting with $5,000, interest rate is 3%, right? So quite a bit less. On paper, that's 40% less a rate of return in you're paying. So you're thinking, well, logically, if I'm paying 5 and only earning 3, I'm behind right out of the giddy up. And that's what Dave and George would try to convince you, that you're an idiot for only earning 3 and paying 5 because you're always behind. Well, let's look at the actual math, because that's just marketing. So when you scroll down here, so in the first year, okay, you've only gained $150% of interest on that 5,000. So you're behind in the first year, because if you remember before the amortization here, let me go back, it was $215. All right. But then in year number 2, you've gained $304 of interest. So you're ahead. And then every year, look, it goes up. 463, 627, 796. Look how much that continues to go up. But it's only 3% and you're paying 5. How is that possible? Well, it's because of the whole thing that we're discussing here about it does make sense to borrow, because you're going to come out ahead. Now, it may not be quite this significant with a policy, because there are internal charges with a policy, even in whole life. So your net rate of return, may be a little closer than this, but generally you're going to come out, even at worst, a break even, to where I've got money growing for me. I'm taking a policy loan. I'm in a break even. I didn't lose the future opportunity cost of the money that's in my policy, still able to grow by withdrawing it and cutting off the compounding, because compounding, the longer you have it, the greater it gets. I mean, look at this. I did this 3% on $5,000 for 40 years. Look what this turns into be, $11,000 of interest, $16,000 of principal. So that's a 3X right there. You went from 5 up to over 15. Yep. So you doubled your money twice, in a sense, or well, not quite twice.
A little over triple it.
Yeah. In 40 years, right? So that's the power of it. And look at, in these last couple of years, the interest growth that you had. I mean, it's pretty significant, right? It goes up pretty well.
And it's not taking into consideration what you saved and lost opportunity costs as well. So your policy is growing, but then you start to add numbers up with lost opportunity costs. I mean, the numbers just get staggering. And this is the difference between compound interest and simple interest. It's why when you actually look at the numbers and you turn off all the hype, all the crappy marketing, and you actually look at the numbers make sense. It makes sense to pay a little bit of simple interest to earn uninterrupted compound interest. And that's what whole life insurance policies allow us to do. I've run similar numbers with my car. I paid $28,000 for it. I did this on my channel, but I ran it very similar to you, where I was compounding at 4%, but I was paying 8% over 5 years. And Jeff, after 5 years, even though the interest rate was half of what I was paying, my compound account in that example was ahead in 5 years, like the ending balance compared to what I would have paid with the loan. That's the power of compound interest, guys. That's why it absolutely makes sense to borrow from a policy to eliminate lost opportunity costs and continue to get that uninterrupted compound growth, period.
Yep. Here, let me make one correction. I guess I was looking at the wrong column here on the growth. I was looking at, that's the accrued interest. So 150 to 304 is, the accumulated. So for year over year, you're behind, the first couple of years here, 215 is what you're paying on the loan, 199, 159. So, at year 3 basically is the break even point where you earn 159. And then after that, you're earning 163, 168. It continues to go up. And we're over here, you're paid more than that, what you earned in the first couple of years, but then it's going down. And that's where you're doing this over a long period of time. Break even at worst, or you come out ahead, and that's the whole point of why we would do this.
That's it. Love it. Great example. All right, let's finish up. I think he's just about done here. Then he's going to start talking about Xander Insurance, but we'll just finish up here real quick.
Your own money. But hey, if your investment ends up doing well and doesn't eat its own weight in money, at least your family can live on the extra investment money after you're gone, right? Think again, my friend. Here's a real stinger. Your family only gets the original amount the policy was worth. In other words, if you bought a $250,000 policy but ended up with an additional $180,000 in your investment account, your family still only gets $250,000 if you...
All right. I got to do it. I know I tend to go on a rant sometimes. We're almost at an hour and a half, which I could talk about this stuff forever. I don't know what your time constraints are, but here's the thing, man. Again, it's just a fundamental misunderstanding of how life insurance works. It's just terrible marketing to make it sound really bad. So you buy what he's trying to sell. It's just extremely frustrating. I don't know why people expect to get both the cash value and the death benefit in a whole life policy. Would you expect to get, if you're, this is the example I give. If you have a $300,000 house, you have a $150,000 mortgage on it, you have $150,000 of equity. Well, let's say tomorrow you sell the house for that $300,000, what it's worth. Would you honestly expect to get the $300,000 plus the $150,000 in equity? Or would you just get the equity? You just get the equity. I mean, it'd be kind of stupid if you called up the banks like, hey, I sold this for $300,000. I have $150,000 in equity. I should get $450,000. The bank would think you're on crack, right? It doesn't work that way. Well, it's the same thing with the policy. The cash value, it just represents the equity. It's almost exactly the same as in a home. It represents the equity, what you can borrow against it. It's also what you would receive if you surrendered or canceled the policy. That's it. But I actually argue, Jeff, that when you pass away, you get the cash value. Let's do a simple breakdown of how to calculate the death benefit. So let's say I have $1 million death benefit and I have $500,000 in cash value and I pass away. Okay. Well, what's going to happen is the life insurance company doesn't overcomplicate this like we're doing here. They just cut the check for the death benefit. But if we break down how to calculate where that death benefit come from, you could argue that it's the cash value plus whatever the net amount of risk is to the life insurance company. So the life insurance company in this example would look at it and say, okay, he has $500,000 of cash value. We're going to give that to his beneficiaries. Okay. But we're on the hook for $1 million death benefit. So we're going to add an additional $500,000 to that death benefit check. So can we argue that you actually get the cash value when you pass away, plus the additional amounts, which is the net amount of risk to the life insurance company? So it's not like your cash value just disappears or whatever. It just represents the equity in the policy And you could argue that you actually do get it. And not to mention too, these cash value policies, whole life, the death benefit continues to grow. And then I don't know how you feel about this, Jeff. It's a thought that I had when I was listening to it earlier. This is just a bizarre concept to hear from a guy like George, Dave Ramsey, et cetera, who are such big proponents of being self-insured, right? So as the corridor between your cash value and your death benefit get closer, like narrower, I mean, technically you're becoming more and more self-insured at that point, are you not? So
Yep.
I don't understand why it's fantastic to be self-insured on this side of the story of the equation here, but over here, if you're closer to self-insured, this is bad because it's whole life insurance, blah blah blah, whatever. What are your thoughts around that? And then what do you think about the you don't get the cash value, you only get the initial amount? What are your thoughts?
Yeah, I think to me it's perplexing too. I mean, to me it's like you're trying to make pick a fight when there's not one there to be fought. I mean, it's just not even how it works. Like, why would you say that? I mean, I wouldn't say the same thing about, term. Well, you don't get your cash value in term and use that as like a marketing piece. Like, well, duh, there is not such a thing. So the fact that they're positioning it like you should be expecting that, to me, just shows that they have a very low understanding of how they work, because the way I've heard it explained is the cash value is in advance of your death benefit. You're getting access to a portion of it, because if you look at an illustration of a policy, the last year of a whole life policy, like a lot of them that we write is year 121, the death benefit and the cash value are the same number.
Right.
And so the reason it's less the earlier or the younger you are is because it's in advance of the death benefit. It gives you the opportunity to use some of the cash of that death benefit ahead of time.
Right.
So if somebody were to outlive their policy, they do get that same number. It's the cash value, but it's also the same number as their death benefit. So you're kind of splitting hairs by saying that. But then if it's earlier, like, it's just not how it works. I mean, I think the equity explanation is the one that drives it home. Why would you expect to get both? It doesn't make sense. I think it's because they are so convinced that it's an investment account plus a death benefit.
Yep.
So they're looking at it wrong. So they're explaining it wrong. They're marketing it wrong. And then setting this unrealistic expectation, like the agent and the industry and the insurance company, they're all frauds, because look at what they're taking from you.
Right. They're stealing your cash value when you pass away.
Yep. So, that I just feel like they have to know what they're doing. I mean, if they don't, they really should not be producing videos. They should not have a radio show. They should not be talking about insurance. If they want to talk about eliminating debt and living within your means, great, stick to that. But, this stuff really frustrates me, because they're obviously out of their lane when they talk about stuff like this. And if they do know what they're talking about and they're claiming that they're, Christians and all this stuff, that's where it really, really rubs me wrong. So, those are my general thoughts around that. I mean, it just doesn't make sense when you understand how life insurance functions. And the role of the death benefit is there for when you pass, you get access to it early. And, the life insurance company, whatever money you've contributed to it, they're investing that money. It's in bonds, it's in real estate, it's in, a well-diversified portfolio. I've seen some of those at like the One America symposiums. They do breakdowns of where's their assets allocated for their general fund, and it's heavily in bonds, and they know how to make money consistently over a long period of time and be profitable every single year, no matter what the economic situations are.
Right.
And so the money that we've put in there, they're doing something productive with that for the health of their own company. And yes, they're making a profit. So what? We all want to make a profit. We should be making profits. We should all be making profits, So I don't see that as bad. I know that can get spun as like this bad thing, like, well, the company's making money. Well, okay. That's what every company's in business to do, is to make profit. And, I always find that interesting that we bash on companies that are trying to make a profit, but then we're told to invest our money in companies, and we want them to make a profit so that we can have this $1 million portfolio in retirement. So
how are you going to get there if we're not making a profit? Not to mention too, with whole life insurance policies, you're a partner. You own part of the company. You want it to be profitable.
Yep.
So yeah, it's really interesting. It's a really bizarre point, fundamental misunderstanding of how life insurance works. And the last thing I'll say about it too, that I just want to touch on, it's kind of related to this, but I think it's important, is that, you don't have to pay into a cash value whole life insurance policy your entire life. You could set up 10 pay, I know I've seen some people only pay into it for 3 years. And like, if you design it right, it becomes so efficient, so fast that it can actually pay for itself. Right. But you can get, you could do a reduced paid up policy and never make another premium payment ever again. But guess what? The policy is still going to grow every single year. You're going to get that guaranteed growth rate. You're going to get those dividends, which these companies have never missed dividends since their inception. And if let's say you put $100,000 into the policy, and over the course of 30, 40 years, whatever, it ends up being 500,000. Like, are you really, like, why are we complaining about, why are we trying to figure out where the cash value goes and all these commissions that you're paying? Like, dude, there's so much flexibility, there's so much benefit with these things that when you're only looking at the surface level of this and you're not diving deeper into how they actually work, you miss the whole point. Right. So I just want to bring that up. Like, you can pay off a whole life policy just like you can pay off your house. Right. When you pay off the house, are you no longer able to live in the house? Do you no longer own it? Of course not. You still own the house. It's still going to appreciate in value. And it's the same thing with a whole life policy. And I think it's awesome. So,
yeah, let me add a couple thoughts as you said that. So let me explain what a reduced paid up is, because I've been working. I was texting earlier before we jumped on with a lady that we're looking at seeing if that makes sense for her situation, because like you said, you can do shorter term policies, and this policy was set up with a large first year dump in and then a lesser amount over time. And it's stressing her right now because her business was dramatically affected in COVID, and this policy was set up 7 years ago. And so we're looking, does that make sense for her to do a reduced paid up, which means you're taking the amount of money that's been paid into the policy. Let's call that $200,000 of total premium, because this was a large policy. She's got a very successful business. And whatever that amount of premium buys you of death benefit, they stop premium payments and basically, I think you can say technically, issue a new policy at that amount of premium payment and death benefit. It's locked in at that point. You can never lose the policy. It's paid up. You never have to pay into it again. And that amount of death benefit goes with you throughout the rest of your life, but then it continues to grow. Even without adding more of your own money to it, like you said, it still continues to grow. There's still dividends on top of it. And so that is a great way that, to me, that's so much far superior than a cheap term policy that could, like we showed earlier, get out of touch payment-wise. You can't even afford it, and you got to drop it, versus, okay, let's do a single pay. You can do single pay. You can do 10 pay. You can do 5 pay. There's different ways to structure it where you just put in a certain number of dollars up front, and you've paid for the entire lifetime of the policy to serve the purpose that it's going to serve for that long-term, idea. So, that's one thing. And then I think the other last thing I wanted to add on, the death benefit and cash value, you don't get the cash value. When you structure a policy, you look at an illustration, the cash value is always lagging behind the death benefit. Mm-hmm. So if over 40 years I've paid in, $100,000 of my own money in premiums over that time, but my death benefit's 200 or 250, why would I be complaining about I've put in 100 and I get 250 back? Like, you're still ahead. It's not like you paid 250 and got 100 back, like can happen with term, where I've actually put into it more than I'd ever get back out of it. Right. So that, to me, is perplexing too, that you're complaining. I mean, in George's example, you have a $250,000 death benefit, which that's what he means by a $250,000 policy. And I think you used $180,000 of cash value. Okay, well, you haven't put in all 180 of that because it's grown. In the example he's talking about with being a whole life or even an IUL, would, ideally they'd both do the same. Obviously, there's a chance with the IUL side it may not have grown as efficiently, or if there's down years or something, but it's still 180 and you're getting 250. So that's still $70,000 more money. So I don't really get where you can complain and bash the company, because you're still getting more at the end of the day, when the strategies they promote a lot of times can mean you're getting less than you've put in. Even with an investment account, you can have $1 million portfolio, but not all $1 million is yours. So those are some of those things that, again, half truths, point out the negative things about this side, but not talk about those same things that apply over on my side, when they can sometimes even be worse.
100%. Well said. All right. Let's see what his final thoughts are.
I ask, what's the real point of combining insurance with investing? If you said helping insurance companies make more money, give yourself a gold star and a high five. So let's compare IUL with term life insurance, which is designed to keep coverage simple. Term life companies know the cost of insuring you goes up over time. So based on your age, the company looks ahead 50, 20 years and offers you the average rate for the entire term. That price gets locked in throughout the life of the policy. No fluctuating premiums and no worries about a bad stock performance wiping out your policy. Sound like a smarter way to protect your family's finances? You'd be what's known as right. And with all that money you're saving on premiums, you can invest the difference and build wealth on your terms. If anyone depends on your income, you need life insurance. It's there to replace your income if you die. IUL might do that, but it might also rob you blind before you ever see the benefits of it. Term life is the only type of life insurance that doesn't rip you off. So if you don't already have it, I recommend talking to Xander Insurance.
Okay. All right.
Yeah, I mean, I think we've belabored most of the points already.
Yeah, it's been fun. So, saying like term insurance is the only one that doesn't rip you off. Term insurance is the only insurance that you don't get anything out of most of the time.
Mm-hmm. Yep.
Well, I shouldn't say that, because IUL, like a lot of these UL products, you don't either. A lot of the time. Mm-hmm. Like I've just seen so many stories of people's UL policies lapsing, and like the way that it's sold, can it absolutely be a ripoff? Yeah, 100%. He was saying like this being like these IULs are massive profit centers for these life insurance companies. That is absolutely a fact. And versus so like Chris Kirkpatrick, our mentor, he says this all the time. It's like with IUL, you're a profit center. With whole life, you're a partner with the company. You're a profit center for the company. With an IUL, you're a partner with the company with whole life. So just think about that. That's a very different type of policy. And with term, when it expires, it's gone. So you just gave all your money away for what? I mean, I don't want to bash term. Like it is important to have the coverage, replace your income, et cetera, during your working years, you got family, et cetera. I'm not bashing that. It's just when he's saying that term is the only one that doesn't rip you off. Well, when that term expires, you've got nothing with that policy. That coverage is gone. With whole life, that is, you could pay it off like we were talking about earlier. It's going to be there for you for the rest of your life. It's going to grow for the rest of your life. You're going to have living benefits where if you get diagnosed with a chronic critical terminal illness, you have access to a very large portion of that death benefit early to be in control of the care that you get, right? You have much more control over your medical directive, right? I think there's so much power in that, not to mention the death benefit too, like leaving a massive legacy for your kids, charity, whatever. Volatility buffer in retirement. So let's say you were building wealth with the policy like you should be anyways, right? And you've racked up a portfolio. Okay, now it's time to withdraw. Well, what happens when the market goes down? You don't want to be selling off assets while the market's down, right? So now you can tap into your whole life policy over here while the market recovers, and now your portfolio is going to last you. Mm-hmm. How is that bad, man? How is that a ripoff? How is term so much better than that? Term doesn't do any of that. So that's why
I agree with you completely. I think the big fallacy, I'm dealing with a client right now that happens to be a family member, and she's been down the traditional financial path her whole life. And this is coming down to where we're looking at some strategies that, she hasn't thought of some different gaps in her plan, because she was told that this massive pile of money was going to solve all of her problems. It'd be her self-insurance. It'd be her long-term care.
Yep.
It's going to be such a big amount of money that even if you ride through a downturn in the economy, like it'll come back and you'll be fine. And it's this one size fits all, one product that's going to supposedly do all these things in your life. Right. And we talked about earlier the efficiency that a lot of times is lost by trying to have your investments be your insurance, and have your investments be your inheritance, and have your investments be your income in retirement. Because, there's a lot of factors that go into a solid financial plan. And, there's a lot of research out there that some very brilliant minds have done that show that having everything in the stock market is not going to give you long-term success when you're trying to pull money out of retirement. Right. You can run out of money. There's a lot of risks. There's fancy names for those risks, but you can run out of money. You can have, we talked about the volatility buffer, where the market goes down and you're trying to take money as income that same year. Well, you just double dip negatively against your account. Yep. So it's really hard to have that come back. Yep. And you mentioned the very important point of what the death benefit can serve for the living benefits. And those are just all these, there's gaps and holes in traditional financial planning that whole life fits those gaps and makes you more stable and more confident in your retirement years.
Right.
And I've been doing a lot more research on the annuity side and how that fits into a financial structure and plan for retirement and beyond. And it's amazing. One of the stats that is really, I think, very, very powerful, that really, I think, speaks to whole life. I don't know if the same data is there for whole life, but with annuities, when somebody has a fixed annuity, so their income is guaranteed in retirement, they've looked at that, and people live 20% longer when they have guaranteed income in retirement. So the
really?
fact that you have guarantees, certainty, control with an annuity adds to more life and less stress. Whole life does the exact same thing. It gives you more control, less stress. It fills gaps in a plan that are inherently there because a pile of money isn't going to solve all the problems.
Right.
And so that, to me, is what it falls down to. Is term life, yes, it is an absolutely powerful tool for what it's used for, but it does not do all the things that whole life can do, from conception to the next generation. This is such a powerful, flexible asset. Term life is a one product, one use case product. I mean, it does one thing. That's it. It doesn't provide you any other benefits, which that's a loss of efficiency.
Right.
And there's people at the place where that's all they can afford, and that's a good starting point. And that's where we would recommend, like you said, convertible term, so they can have their insurability locked in. They've got the protection, but it can convert over to something that's going to produce more efficiencies for them and turn into something more. And those are just a lot of the things that we have been trained with and help clients with specifically, so that they're getting the most out of their financial plan and planning for worst case, not thinking you're going to be a multi-millionaire in retirement, and all the other contingencies that we've talked about are irrelevant because you can just throw money at all your problems and they're all going to go away.
Right. 100%. I think the peace of mind part of it, peace of mind aspect, is often overlooked as well. I call that external rate of return. Like the peace of mind that you have knowing that your money is going to grow every single year. It's with the most financially sound companies in the world, right? Mm-hmm. You have this massive death benefit in case something happens to you. Like, man, I sleep pretty good, knowing that a large portion of my money is in these policies, and I have control. I'm able to take advantage of investment opportunities like I'm doing right now. So it's not like I put my money in a whole life and now I can't invest in anything. I can't use that money to invest. I can. That's why it's called the and asset. Like, I put the money in the policy first. Now I borrow against it. There's a little bit of interest cost, but we already talked about that. I can still build wealth. So it's not like when you buy a whole life policy, you can't build wealth anymore. That's it accelerates the wealth building process. And then the last thing I would say about like this buy term and invest the difference thing, again, it's not that people shouldn't do it. If it makes sense for you, that's fine. But you got to think about these things. Let's say you rack up that coveted $1 million, you hit that $1 million mark in your portfolio. Well, that's great. But when you're in retirement and now it's supposed to solve all these problems, it's supposed to be your income for the rest of your life, or part of it anyways. It's supposed to cover long-term care expenses, whatever, right? Well, in order for that to actually happen, you can only take 2-3% a year. I think it's 3% now. The 4% rule has kind of gone out the window. I think it's 3% now, in order like when you account for inflation. Well, Gary Gunderson calls that scenario, you're a broke millionaire. So if I have $1 million in my account, but I can only spend 30,000, what good is that? What good is the $1 million at that point? So it's just, I don't know, that kind of stuff just doesn't make sense to me. But at the end of the day, guys, you got to figure out what's best for you. Like, I'm talking about like the buy term and invest the difference doesn't make sense for me, but that's me. That's just based on my personality, my risk profile, the goals that I'm trying to accomplish and the amount of control I want with my finances. That's me. Okay. It doesn't have to be you. Right. But you need to know what your options are. That's the most important thing for me, is just know what your options are, educate yourself so that you can make the best decision for you. That's it. That's it for me.
Yeah, I think one last point for me, what you're talking about with the control, I hear this from a lot of clients where they've got money in the traditional places and they're afraid to touch it because of the penalties and because of the taxation part of it. And that's the control part. They don't have control over that money. Right. They're afraid of accessing that money because of a fee and because of taxes. So you lose control. So I argue too, I agree 100%. Like, what's the point of having a multi-million-dollar portfolio and you're still living basically middle class? Like, you're a millionaire on paper, and there's different definitions of millionaire. I mean, I forget the technical names, but there's, basically the paper, the accounting millionaire that, assets minus liabilities, your net, yes, you're a millionaire. on paper, but then there's more of the lifestyle millionaire that they don't live on 30 grand. They live on maybe 500,000 a year because they're a true, what I think of as a millionaire is not just somebody that has that locked away in some hard to access, don't have control over a bank account or investment account. It's that I have millions of dollars worth of assets. It's a business, it's cash flow, it's whatever that looks like. And I'm living a different lifestyle. You know, I'm flying first class. I'm not flying coach. I'm maybe even doing private jets. I know people that are true multimillionaires. They're flying on private jets around. You know, that's to me a millionaire lifestyle, not I'm living on 30, 40 grand because I feel good about my account balance, but because of that lack of control and because of that disconnect, I'm really not living the way that I'm, you know, marketed to of how good it really is. So I think those are the last couple of things that I want to touch on. So yeah, good conversations around all this. And, you know, I've been wanting to do this video recap for quite a while, actually. So I'm glad we were able to knock that one out because I think this one served a lot of functions. It was able to point out some strategy stuff and how we look at things differently, talked about the IUL, the pros and the cons. And I think this one last thing I will add, you know, Caleb Williams, that's, you know, one of our kind of sub mentors in the business because he creates really good content. He's been putting out a lot of content recently, interviewing people that are very pro IUL and whole life and talking about when does it make sense for IUL and how would they need to be structured so that some of those levers that are able to be moved, they're not going to put you in as great a potential to lapse the policy. So I'm always somebody that wants to continue to learn. I don't want to be this like 100% across the board anti-IUL. I'm like you, Matt. Like I want to know these products inside and out. I want to know when is the right situation for an IUL for a client because I'm probably going to come across that. And if that's the right fit for them, but I push them into whole life because of my biases and my beliefs, and I do the wrong thing for the client when the IUL was the right thing for the client, I can't sleep at night. So that's where I want to take this is I want to understand the IUL better and where does it fit in a financial plan for the person that it's best for, you know? So I'm starting to, you know, make sure my perspective is balanced and taking in information. I watch pro IUL channels all the time because I want to understand where they're coming from and where is it in their eyes a good asset. And this is my very last point is there's a book coming out, I think pretty soon by David McKnight called The Guru Gap. And he talks about I've watched the interview with him and Caleb and it's phenomenal talking about a lot of the things that we just went over in this video and how the gurus on TV or on social media, there's usually gaps in what they talk about because they have to make it broad strokes for everybody to follow the advice. And there's usually some things that are not quite accurate. And there's going to be gaps in what they say that for an individual basis, you're going to need more personalized help. And that's where Matt and I come in is to do that fine-tuned coaching and mentoring and strategizing so that we're doing the right thing based on you, your situation, your values, your beliefs, your goals. That's really what it comes down to is making sure that it's that. If you follow broad strokes, you're probably going to not get as accurate of a strategy that you need to get you where you want to go. You're probably going to be missing the mark someplace. You're going to lose efficiencies. There's going to be things overlooked. And we don't want that to happen. So, you know, if this kind of stuff resonates with you, you want to understand the stuff deeper, want to know how it apply in your life, reach out to Matt or I because, you know, this is what we do. We love this stuff and we've been trained very heavily in this to have a very well balanced understanding and be able to point in the right direction.
Yeah, 100%. Well said, man. You know, I say it on my channel all the time, even though I'm not a fan of IUL, it doesn't make sense for me. I would never tell somebody to never buy an IUL. It just comes down to your own situation, right? And I think like the the videos and conversations that Caleb was having is really good. I want to try to do more of like those on my channel as well, where we're having conversations with IUL agents and understanding where they're coming from and stuff like that. Because I think those are some of the most productive conversations you can have when you're like around this type of topic. You know, do I do an IUL? Do I do whole life? Do I do either of them? Right? You need to hear both sides. And I think those conversations are really good. And last thing I'll say is just pose a question to people is, do you want to get the highest rate of return? Do you want to like rack up, you know, $1 million stock portfolio, or do you want financial freedom? See, you might be able to rack up $1 million, $1.5 million stock portfolio. Maybe my cash value life insurance only gets to $1 million. You have 1.5, or you have 2 million. How much can you spend? Is there true financial freedom there? One of the best quotes that I heard since I got into this industry is buy your net worth, build your cash flow.
Bingo.
Right? Stop trying to accumulate so much. How about we focus on building cash flow? Because again, if you have $1 million portfolio, but you only spend $30,000 per year, that's like barely above the poverty line, man. And Lord knows what that $30,000 is going to get you 30 years from now with inflation, right?
Right.
So just a different way to think about it, guys. So we'll go ahead and wrap up with that. Jeff, as always, man, I love our conversations. Really, really good stuff. I think this was really, really good. Hopefully you guys found value in it. Put a bunch of links down below for additional training and resources. And yeah, reach out if you want to have a conversation. With that said, Jeff, until next time, my friend, I appreciate the time.
All right. Always a pleasure, man.